Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. Financial markets have really evolved over the years as markets move quicker than ever. And this has resulted in new dynamics for investing as correlations between historically low correlated assets have increased, which makes building diversified portfolios more difficult, which has resulted in new investment products and strategies. Well, I have on the perfect guest, an industry expert, to share her insights into some of these new investment strategies and the modern approach to diversification. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. Let's go ahead and get started and move on to the star of the show. I'd like to give a very warm welcome to Paisley Nardini. Paisley is a managing director, head of multi-asset solutions at Simplify Asset Management. Paisley, thank you so much for coming on. It's an honor to have you on. I'm really excited about this conversation. Could you please tell us a little bit more about yourself and Simplify Asset Management?
Of course. Well, thank you, Ryan, for having me. And this is a topic that is near and dear to my heart. So I hope that we deliver and we could talk for hours, but we'll keep it tight today. So, quick background on myself. I've been in the industry for about 15 years, started as a bond trader, and have kind of worked my way through asset classes and client facing behind the Bloomberg screen all day. And have really landed in this role where I'm working with clients every day. I'm talking to investors, I'm talking to advisors, I'm talking to the external markets to talk about
Mm-hmm.
what's going on in our portfolios, what's going on from a risk perspective, what are our headwinds and tailwinds, and doing this across asset classes. And I think what's really important, because very few of us have all of our eggs in one basket. We'll come back to that
Yeah.
concept in a moment. We're not invested in just stocks. We're not invested in just bonds. We're invested in all asset classes, and how those come together is where I've really spent the last decade of my career. How can we build more resilient portfolios? So excited to dive into this topic today. And maybe by way of background, a little bit information on Simplify would be helpful.
Yeah, that'd be fantastic.
Okay, great. So Simplify Asset Management actually just passed its 5-year anniversary. We launched kind of in the depths of COVID as many innovative, unique companies came to be. And we also just passed 11 billion in assets under management this month as well. So we have been coming up the curve very quickly. And ultimately, the reason I believe this is that we are filling a gap within the
Okay.
markets where investors are looking for solutions. They're looking for ways to express their unique investment views, whether it be tactical trades or long-term
Mm-hmm.
thematic plays within portfolios. And we're also doing this by providing investors access to liquid alternatives. And I think this is a topic we can discuss as well. When we talk about ways to diversify from stocks and bonds, a lot of times private credit, private equity comes to mind. And whether or not that's appropriate for individual investors or advisor portfolios, sometimes it's just not accessible. We have clients as an advisor that have really small individual accounts. They need ways to diversify their risk, and maybe private markets are not the best solution for them. So this growing basket of liquid alternatives continues to play an important role in thinking about how to diversify risks beyond traditional stocks and bonds. And then lastly, I might just mention, we came to market, we've been successful, but why are investors asking for this? What is the need behind this? And I would say a couple reasons. First and foremost, obviously, the growing number of baby boomers who are moving into the retirement phase. So moving from that accumulation to decumulation phase, where income is becoming increasingly important in investor portfolios. And so traditional bonds, even with rates, higher than they have been in decades,
Yep.
4 or 5% in your core bonds, it's not super exciting or sexy. And so these more innovative solutions and equity income or higher yielding assets continues to get a lot of attention in the industry. So that's one gap that we fill. And I would also say moving beyond kind of these very concentrated parts of the equity market. And I don't just mean, diversifying away from the S&P into the NASDAQ 100. I mean, really thinking about unique sources of portfolio risk and return to build more resilient portfolios. And then ultimately, too, why is this so important, right? Why weren't we talking about alternatives and diversifiers a decade ago? Well, something really interesting happened 3 years ago, and it was the correlation or the movement between stocks and bonds for the last 20 plus years. They'd been negatively correlated. So as your stocks went up, your bonds would go down and vice versa. So that meant it was easy to build a portfolio with stocks and bonds. You had the ballast or the protection from your bonds and the income. You had, the capital appreciation from your equities. Well, 3 years ago, stocks and bonds started to move together. And so ultimately, what that meant is that we no longer have that solid, strong diversification from the bonds in your portfolio. So that's why alternatives are front and center. And that's what we'll talk about a lot today is how to diversify.
Yeah, Paisley, that is fantastic. Way to set the stage for this conversation. That was awesome. And this conversation, we got, I'm going to do my best to stay on track because you're from Minnesota. I love the Badgers, Wisconsin. So we're going to do our best to keep it on
Yeah,
track.
Ryan and I talked about in our prep call. We tried to come to common ground here, given Wisconsin and Minnesota are usually enemies, but we're putting our differences aside for
Yes,
today's
we will,
discussion.
for the audience's sake. That is fantastic. You mentioned a lot, the importance of alternatives. And, the 60/40 portfolio, it's not what it was years ago. So it's a good maybe starting point, but you have to add diversification. You brought up a great point. Everyone talks about private equity, private credit, but as a retail investor in a lot of financial advice, how do you get access to it, right? So you brought up a good point about different products. What are some trends you're seeing play out in current market environment? You talked about correlations as equities and bonds moving together. Any other trends you're seeing?
I think a couple things I always like to be like the 30,000-foot view, because if we
Hmm.
get too into the weeds, it probably won't resonate for everybody. But what impacts every one of us, again, we're probably not all running an entirely 100% equity portfolio or 100% bond portfolio. So the importance of diversification and specific within equities, it is no surprise to anyone. And if it is, then you've been living under a rock. The US equity market has become increasingly concentrated over the last decade. And this, in my opinion, it makes sense if we look at the underlying drivers of these companies and what's moving the economy and where the innovation and productivity and the margins are is in a couple stocks. It's these large tech
Yep.
AI oriented companies. So by no means am I saying their valuations and their place or, position sizes in these indexes isn't warranted. As an investor, if you have this information and you understand that only a few stocks, I heard a statistic on a podcast this morning, I think over the last, let's say 20 plus years, 30 plus years, 4% of the entire list of companies that are investable have driven almost 100% of the returns. And
Yeah.
so if we're looking at where we're investing today, and it is front and center, it's right in our face, you cannot avoid it, that only a couple companies are leading the charge, driving our entire net worth and our ability to retire comfortably, that should make you nervous. And so I think this idea around how can we diversify our risk within a portfolio so that we can get to that destination, because it's all about the journey. You can't get to the destination without taking that journey. And the more bumps that you have along the way, it just makes it more difficult to stay on track. And so how can we smooth returns along the way? Diversifying in the key source of your portfolio that drives risk, which is equities. If you have a balanced portfolio, let's just say a 60/40, 90% of that volatility that you experience in that portfolio is driven by your equity risk. And then now to say that's driven by, 2 to 3 different companies, again. So how can we think about diversifying in our equities? And as Harry Markowitz said, diversification is the only free lunch. And I do think that's a powerful tool and allows us to put our head on the pillow at night and say, I'm not going to be concerned if I wake up tomorrow and Nvidia is down 20% because I've built a resilient portfolio. The other thing I might say from a big kind of macro perspective, like what trends are front and center, I would say the reintroduction of active management. And if we look at the ETFs and the strategies that have come to market in the last 2 years, for the first time in decades, we're actually seeing the average expense ratio of ETFs start to creep higher. And that's because investors, I think, are already starting to recognize the risks of being entirely in passive. And so active managers like Simplify and many of our peers are bringing strategies to market that have more certainty of outcomes. We've heard a lot about downside protection. And I think that's something that's increasingly important. Investors want to know what's going to happen to their portfolio within certain range. Of course, you're not going to
Yep.
have 100% certainty.
Yeah.
But I think that reintroduction of active risk is really important. And it's not just active management to shoot the lights out and get the highest return, actively thinking about how to protect on the downside to smooth the investor experience or that journey again. And then the last thing I might mention, even more, come from even more of a macro view, would be this greater volatility that's being injected into the markets in this post-COVID area. So whether it be our government leaders, policymakers, world leaders, there's a lot of intervention in fiscal policy and monetary policy. Of course, tariffs are front in mind. This was all injected into markets and into the economy. And I don't see that letting up. I think there's a lot of tensions within our borders, cross borders, that will have us kind of sitting on pins and needles. When is the next shoe going to drop? When is that headline going to hit? And I think that this is shifting between that stock bond correlation that we discussed, that kind of kicked off why this is important to have diversification.
Yeah.
But now, because of the increased volatility being injected into markets through all of these tensions I've just described, investors are likely going to have to revisit how they're constructing their portfolios.
Yeah, that's fantastic, Paisley. That last comment on all of that interjection, whether it's fiscal monetary policy, it's like, do we really have free markets? Is the financial markets or the Fed just each headline controls markets probably way too much?
Way
Or
too
we
much.
rely so much on the Fed and their headlines and what
Yes.
Fed speak. It's like, how free is it? And then with risk, I'm so glad you brought up about drawdown risk. I've done a lot of research. Zephyr's done a lot of research about really what is risk. And a lot of people for years, they use standard deviation. Well, standard deviation, especially on the upside, really isn't all that bad. Give me all the upside deviation you want.
Exactly.
It's that downside deviation. It's that drawdown risk that to me is really the risk of investing. So like you
Yeah.
said, how do you limit that? How do you smoothen out that ride so you reduce that drawdown risk? Because like you said, waking up in the morning and your portfolio is zero is the biggest risk out there.
And this is something I would like to touch on as well. And I mentioned this term to you the other day, which is prudent participation. I think a lot of times investors, or if you're listening to a lot of the, stuff going on in the media, talking about all these risks and doom and gloom and, run to the bunker and, buy, move all your assets to cash. Like there's so many catalysts and tailwinds in the market right now that are likely to continue to move markets higher. There's some interesting statistics out there from Ryan Dietrich at the Carson Group, actually, that talk about where we are historically in a bull market, the average duration of bull markets. We have a lot of room ahead of us to run. And so by no means would it be prudent to just move all the way to cash. You want to participate in the markets. You want that upside potential. It's just doing so in a prudent way. So going back to my comment earlier, you have the ability to ride the entire trail all the way to your destination. Because if you're not being prudent, you're not diversified, highly likely one morning you will wake up and you'll have significant losses in your portfolio. So if we do have this long runway ahead of us, how do we prudently participate, capture upside while still thinking about those risks? And this comes back to the increased desire for certainty and more defined outcomes. And that's why I think this cohort of the market, this derivative income strategies have grown so much. It's addressing this need for higher distribution to meet, again, this aging population. It's providing downside protection in a lot of instances through buffers and barriers. And so I think this is all things that are resonating. And though there's people that are out there quite loudly or vocally pointing at all the reasons why these defined outcome buffer barrier type strategies have flaws. And again, I would go back to say, like, there is no, perfect solution in the marketplace. And is it a flaw if, as an investor, you feel more confident and understand what is your potential drawdown and when do you start to get protected? How much income are you going to achieve on a monthly or quarterly basis? Those definitive kind of guardrails, to me, again, I don't think that's a flaw, even if it means you're going to cap your upside. Are you more prudent in the way you're participating with more defined outcomes than just throwing it all into a passive market and hoping and praying that Nvidia keeps over delivering on its earnings?
Yeah, I love that point you brought up about passive versus active. Right? You can be an active investor and still invest in ETFs. Like you said, all these products, Simplify Asset Management has them where they're active ETFs, their expense ratio is still lower, but you don't have that concentration risk that you mentioned. I worry about all the people that are investing in a spider VOO and they don't realize the concentration risk. They're not diversified in what could happen if Nvidia crumbles by 30%. They have a spider and then they have a tech fund or something growth fund and they have a huge concentration. You also
Yeah,
brought
actually,
yeah,
sorry, Ryan, one comment I think is really interesting. We just did our quarterly market update like a week or so ago, and a stat that I had shared, which actually comes from Jim Bianco,
yeah,
is for a lot of advisors, and I've worked with advisors for the last decade to understand like where are the risks in your portfolio, how are you allocated, how can you optimize? And many advisors will have a large chunk in the passive S&P 500, which, to be very clear, does serve a purpose as a core. And then you can kind of have this satellite approach, is how I think about it, with more defined approaches, more diversification. But S&P 500, and then they'll diversify to say the NASDAQ 100, because this is where they're getting more growth and technology and innovation. Well, guess what? The same top 8 stocks
or,
make up the S&P 500 and the NASDAQ 100. So as an advisor, if you're looking at your portfolio and you say, yeah, well, we got, large cap core, we got large cap growth, like we're diversified. The NASDAQ 100 is a more concentrated version of the S&P 500 right now. So forget that, throw that idea out the window. They can still be in the portfolio. But again, a lot of this comes down to whether it's not all in or all out. It's about how you size the positions. That is the biggest driver of are you being prudent in a portfolio, is how you've sized these, because ultimately you can have 10% in something or you can have 80% in something. And we know that's going to be a very different outcome for your portfolio.
yeah. And you mentioned Markowitz at the opening. He did a lot of research and it was, 90% of a portfolio's returns or variations returns are based on asset allocation, right? How much should we invest in Spider versus Nasdaq? But if they're all highly concentrated, you probably have 99% of your variation of returns in those two names. So does it work? And you brought up those defined outcome products. Yes, there's some issues. There's issues, like you said, with every investment out there in a silo, right? In a silo, yes, they're not a great product, maybe, but when you put them together in an asset allocation in a mix with everything else, they play their role. They have a role in that portfolio, and they do it well. So
Absolutely. I think a lot of people too are under the impression that every single investor's goal or objective is to significantly outperform. And I think, and again, I've spoken to advisors and clients over the last decade or so. Yeah, of course, it's nice when you had a couple home runs. But again, if you're thinking about a short investment horizon over the next 6 to 12 months, like you want to outperform. But over a
yeah,
20, 30, 40-year investment horizon, your goal is to really keep up. And so I think when you start to be a little bit more true to like what actually happens in the marketplace, again, that ability to be in control and understand like might if the S&P is up 30% this year and I'm only up 15%, did I fail or did I achieve a pretty attractive long-term annualized return in the equity market? And so I think again, as an industry, we're always so tethered to whatever asset is moving the fastest and the highest. And that becomes our new goalpost as to where we want to be. And if we continually are running around and moving that goalpost, it's going to be really hard to keep up with that. I've even seen, just being funny, in the last couple of weeks, people have started to put various asset classes or stocks in a chart relative to gold. It's like, oh, well, this stock has done so well. And it's like, yeah, well, relative to gold, it hasn't. So again, I think it's being realistic about what the long-term goals are and not getting too caught up in a lot of the momentum and these parabolic moves that we've seen in markets.
I completely agree. When I say, I'm going to age myself here, Paisley, when I started 20 years ago, it was all about keeping up with your friends at the country club. It's changed, what you're doing, talking to advisors, educating them. It's evolving, maybe not quick enough, but people are now focusing long term. All we need is to achieve our goals, right? With the lowest amount of risk.
Yeah.
And that's the way it should be. And I think we're getting there closer than what we were obviously 20 years ago. So great job to everyone out there who's focusing on that. What does diversification look like to you?
That's a big question. What does diversification look like to me? At the end of the day, whatever your objective is, if you have a specific yield target or distribution target, if you have a long-term appreciation target for growth reasons, it's how can you combine as many differentiated sources while meeting that objective? And I can just give you an example. I'm a portfolio manager on one of our strategies where we have a target 12% distribution. That's pretty high. There's been a lot of strategies that have come to market as of late with equity income and derivative usage that easily achieve a 12, if not 15 or 20% yield. But how do you achieve these higher distribution targets or yields? By combining multiple sources. And that's where this starts to become something where I think it's best to leave it to the experts, because diversification is how do you combine almost as many sources of risk and return while still meeting that objective? So rather than going out and buying one fund with a 12% yield, how can we combine 5 funds, 6 funds, 7 funds, and still get that yield target? And so that's one example. But how do I think about diversification more broadly? I think it's, again, about the journey and the destination. Is how can we combine sources so that when you wake up one day and you've sized these appropriately and you have multiple sources of return and risk drivers, you're okay with one of these asset classes, like gold, for instance, being down 5-10% in a couple day period. You're not losing sleep because you've poured too much into gold. And so that's what I always think about it very simplistically, is like diversification means you don't need to check your account statement every day. There will be bumps, there will be hiccups. How can you restore sanity to yourself, to your clients, by incorporating differentiated sources of risk and return? And then more technically speaking, diversification to me is combining sources of risk and return that have low and even, if possible, no correlation. An example of this is historically bonds and stocks have had negative correlation, meaning that if stocks go up, bonds usually go down and vice versa. So now all of a sudden stocks and bonds are positively correlated. Okay, so now we need to find a new source of ballast or offset. Yep. And that's where we start to think about a lot of these liquid alternatives and ways that we can build a more resilient portfolio so that if stocks and bonds are both down in one day or 1 year, like they were in 2022, yep, we have this other leg to the stool or this other sleeve in the portfolio that ideally is behaving in a very differentiated way so that when it's like a seesaw, when one side is down, the other side is coming up. And ultimately what that means too is that you may have to sacrifice on return potential. But again, if we're all being honest with ourselves, very, very few of us are great at market timing and calling the bottoms and calling the tops. Yes, but some people might say they're great at it. But again, if that were the case, I think we'd have a lot more really successful active managers out there.
Yes.
But at the end of the day is this space of alternatives coming into the portfolio. And I also think too, we spoke briefly about private markets. Private markets are a diversifier in a portfolio, but they're ways to diversify for more upside risk and more yield. I view them as levered plays on unlevered public markets. So if you're thinking about, if your objective in your portfolio is long-term capital appreciation growth, majority of your portfolio is probably in equity. By moving into private equity, you now have a levered play on equity. The volatility just because it is a private structure, might be lower as well. We don't need to discuss the concept around volatility laundering, I think, as Cliff Asness coined it. But view those as levered plays. Also, private credit.
Yeah.
Traditional bonds in the high yield space right now are paying you 6, maybe 7%.
Yep.
You can go into private credit and get 10, 11 plus percent. So that's a levered play. It still has beta. So liquid alternatives are this new frontier for a lot of advisors where it's not so much about getting a levered, upside potential. It's more about how can I truly diversify my risk by having low to no correlation. And we can talk about a couple examples of that, but we're really talking about when your equities roll over or your bonds aren't doing great, these liquid alternatives have very unique sources of risk and return that oftentimes are untethered to economic growth risks. And that's why they can deliver uncorrelated source of return.
Yeah, that's fantastic, Paisley. And I'm glad you brought up liquid alternatives because right now so much is made of the private markets, private equity, private credit. Had a lot of conversations with people on the podcast and not on it about bringing private markets to the retail side. Private markets are going to be in 401k plans, potentially private. It's happening whether you like it or not. I think it's good, but there's a lot of education that needs to be done. And again, in a silo, it may not work, but together in a full portfolio, it will if people understand what they're getting themselves
Yes.
into. Are there other pieces, like you mentioned examples within liquid alternatives that are a good diversifier that maybe some people don't think about right now because private credit and private equity are taking all the headlines?
Yeah. So the one that sticks out to me that is absolutely something that should be on everyone's radar, if you are truly looking for an uncorrelated and differentiated source of risk and return. So again, if you're just looking for a levered play and ways to increase your return potential and outperform US equities, like this isn't what we're talking about. We're
Okay.
talking about truly what bonds have been for equities for the last several decades is this ballast, this offset
Yeah.
that we could rely on. And that is managed futures.
Okay.
And managed futures is an area of the market that's been around since the 70s. And if we go back from an educational perspective, futures trading came about because of, think about it. If you were a farmer and you had cattle or soybeans and you knew that you had to deliver those and you wanted to lock in the price in case the price would fluctuate between when you harvested the grain or when you built out your cattle inventory, you wanted to have that certainty or that stability to know that you could continue to generate income for your business, you would lock that in through futures contracts. So if that was back in, the mid 20th century. Let's fast forward now. Futures trading really took off in the late 90s for hedge funds to think about ways to kind of arbitrage some of this. So rather than locking in prices on commodities, for instance, we could start to arbitrage some of the opportunity and think about trend following as well.
Yeah.
And so managed futures is this massive business that historically has done extremely well in severe risk off environments for equities. They've also been labeled as crisis alpha because of this attribute that they offer. So think about the tech bubble, think about the global financial crisis, think about COVID, think about 2022 when stocks and bonds both disappointed. Managed future strategies showed up in a way that was positive returning for portfolios, and as a result, very differentiated to help offset that equity risk, which is, again, the main driver of risk in a portfolio. So what does that mean from an investor perspective? Well, if you think about, again, if your objective is to provide or incorporate unique sources of risk and return, think about what futures contracts are doing. They're tethered to, agricultural industries. We can also think about going long short in equity indexes or in currencies or interest rates. And so, for example, for the last couple of years, this might get a little too into the weeds, but because front-end interest rates have been so high, the interest rate curve has been inverted. And so by being able to go short bonds over the last couple of years, you've actually been able to earn some pretty attractive returns. As bonds continue to underperform, if you're short them, you can earn a nice return. So you can see how that's already becoming this offsetting or uncorrelated source of return for the portfolio. And then I would say more broadly, and we can talk a little bit more about commodities as well, but there's so many global macro forces at play that it's making commodities a really interesting part of the market. We want to talk about supply and demand imbalances,
Yeah.
and this could be driven by weather patterns. Is anybody paying attention to what happened to cocoa last year? Cocoa was up over 200%. It had nothing to do with global growth. It had nothing to do with interest rates. It had everything to do with droughts in West Africa, which is where
Yeah.
60% of the global cocoa production is sourced from. Similar patterns in the back half of last year for coffee, supply demand. So again, completely
Mhm.
untethered to what's going on in your stocks and
Yeah.
bonds. So you can start to understand why this is beneficial to incorporate. Tariffs. I think that's what's absolutely impacted commodity markets this year.
Yep.
Thinking about, if anybody was following closely, copper prices in the middle of the summer got whacked because of some news on tariffs that will continue to likely be at play. Some of these global, geopolitical tensions with China and tariffs impact on some of the commodities that we source from them and vice versa. China has essentially stopped buying much of the US's soybean output. And so soybean prices have been under pressure for the last several years. How do you capitalize on that as an investor? You can go long, you can go short, but
Yeah.
being dynamic and being flexible. So that's a really strong example, I would say, for how investors can think about accessing liquid parts of the market that are available in ETFs. It can introduce, again, as that new age or modern way to think about building a more resilient portfolio.
Yeah, Paisley, I'm so glad you brought up managed futures. Like, it's arguably outside of currencies, it's like one of the most liquid markets out there, right? So you're getting a return stream that behaves differently than your equities, your fixed income in a very liquid way, right? But like you say, it can be very complex. So here's your go-to for the financial advisors out there. Outsources, go to specialists, right, that have the ETF product out there and let them manage it. But it's such a great way to add diversification in a way too, like you explained it perfectly in just a couple of sentences, that's easy to explain to your clients. Right? It's not something that you're having to talk about option overlays or anything like that. A future is something that you can, and it's been
It's
around for years.
tangible as well. I mean, we're talking, especially in the commodity space, we can even pivot to talk about what's been going on in gold this year.
Yes.
Whether you're talking to a sophisticated investor or sitting at the kitchen table with, a family member, your ability to talk about what's going on in gold prices or what, talking about chocolate, you're eating a chocolate bar with your family. You can talk about the fact that there's been a lot of droughts. And so cocoa beans aren't growing as much as they used to. And so the prices have to go up. Like that's so easy to understand. And
Yeah.
that's why I always say, like, when you say manage futures to a lot of advisors, they get really nervous. And then you start to break down this is actually pretty tangible and digestible for advisors and for end clients to understand if you position in the right way and explain why this can be beneficial in a portfolio.
Yeah, it's fantastic. And let's about commodities. You perfect segue. I've done some research in Zephyr about the impact, whether it's private equity, just alternatives in general, the different alternative asset classes, real estate, it has on the efficient frontier, building optimized portfolios. I always add commodities because for years that was the alternative. That's you add that along with real estate, and there's your diversification. But recently, maybe over the past 10 years, commodities adds the bucket of commodities doesn't add any value to the efficient
Adds a lot
frontier.
of volatility.
Yes, a lot of volatility, very little return. So
Hmm.
they're MPT and modern portfolio. They're not going to add commodities to this portfolio. You mentioned gold. Gold is a commodity. So how should financial advisors consider this asset class moving forward? Is it still one that doesn't add much, it's a drag, or is it time to rethink it?
I love that you asked this question because I've been spending a ton of time the last few weeks kind of preaching. I've been on a little soapbox, let's say. But commodity allocations, you're absolutely right, is one of those. If you're just looking at the index as a barometer of is this a good asset class for me to invest in? It's lackluster. Why is that? Well, it comes down to construction methodology, actually. And this is why I would be a huge advocate for commodities through an actively managed approach. Why do I say this? Well, if we think about what constitutes, and there's two different indexes out there, there's a Bloomberg index and an S&P.
Yes.
Slight nuances between the two doesn't matter, the details of which is both of these indexes are heavily driven by oil. And oil, because they have a sector constrained approach, or what oftentimes is called a risk parity approach, meaning that the volatility of all the different sectors in the commodity market, they want to have representation from each of these. So as a result, these indexes, again, we've gotten so tethered to thinking about passive indexing as the best method. Commodities is actually a great example, and
Hmm.
bonds is as well, where active doesn't make sense. So these indexes are forced to hold oil and gas. And as we know, and it's quite evident at the pump when you fill up your car, oil prices, for the most part, we live in California, Ryan. So, exclude us from this conversation. I'm
Oh,
upset we have
yeah.
$5 per gallon gas, but for the most part, oil and gas has been in a deflationary environment for the last couple of years. And so that's been a huge drag on these passive commodity indexes and passive commodity strategies that are forced to hold oil and gas. So enter an active approach, you can really avoid the parts of the market that aren't going to give you attractive risk return potential. And you can lean into the parts of the market for all the reasons I just mentioned: supply demand, geopolitical risk, tariff implications that will benefit. And we know commodities broadly are a quite volatile asset class. And
Yeah.
so the worst thing you can do is take on risk or exposure, and all you get in return is volatility. And that it almost entirely explains, when you look at the index level of commodities over the last decade, why it has not been an attractive place to invest.
Mhm.
So some of those examples, whether it be cocoa or coffee, this year actually is super interesting. We've obviously been focused on gold and precious
Yeah.
metals. What's actually super interesting as well is cattle, whether it be live or feeder cattle. Some of the returns from those commodity markets have been almost as strong as gold. But who's talking about cattle right now? No one's talking about cattle except for me, probably.
Yeah.
And so, thinking about taking an active approach to accessing those parts of the market, and as we like to say, commodities when you want them, not when you don't, as
Okay.
well as the commodities that you want when you want them. And I know that sounds a little bit kitschy, but I think it's really important. And so I think commodities broadly have a lot of macro tailwinds, geopolitical risks, global climate change. This is not meant to be
Yeah.
politically motivated. At the end of the day, there are just more droughts in Africa than there was a century ago. There's more flooding in certain parts of the world. It is what it is. It impacts commodity prices. How can you, as an investment manager and as an advisor, take advantage of that?
Yeah. That's fantastic, Paisley. Maybe we need to have you come on, being both from the Midwest. Come on, we can talk pork bellies, we can talk
Corn.
grains, cattle, do another episode just on.
I'll wear my overalls.
Yeah, yeah, it's fantastic. I love it. I love it. And like you said, commodities are very, and I love your point about, yes, when I do the research, I just use Bloomberg Commodity Index, right? It's my bad,
Rightfully
right?
so.
I probably should use, something that has more of an active approach to it, but there's so much at play than inflation, right? Like, it's an inflation play too. A lot of things go into investing in commodities. You do it right and you include it in that portfolio long term, right? We're not trying to time that
Yes.
market at all.
Yeah. But it is interesting. And I get asked the question often, is like, what are investors or advisors overlooking? And I think it
Okay.
absolutely is commodities right now. And to your point, Ryan, when I started in this industry, commodities were a strategic or long-term holding in almost every advisor portfolio that I came across. Whether it was 5% or even 10%. I haven't met with an advisor in the last like 2 to 3 years that has any meaningful commodity allocation. Most of them have zero. And so this is that, not a risk that's hiding in the wings, but an
Yeah.
opportunity that I think is hiding in the wings. Like, if we see an uptick in oil and gas prices, and I think gold was kind of the precursor to getting people excited about
Yeah.
commodities again, but if we see an uptick in oil and gas, all of these commodity markets from even a passive perspective are going to start to take off. The active managers are going to even have a bigger opportunity. So this is something where I think advisors can start to think forward, get ahead of that, and start to kind of reintroduce commodities within their portfolio.
That's a interesting point. Do you think that's because, just again, it goes back to what I mentioned, the volatility outweighs the return, the risk return makeup there, or is it because
I
there's
think
just
that's
other other products out there that they can get exposure to for diversification?
I think it's twofold. I think the biggest reason is the reason you just mentioned. And again, you mentioned maybe I shouldn't be using passive indexes to think about portfolio construction. You should. I mean, when you have to start somewhere, there's a lot of dispersion
Yeah.
in active managers. So using a passive index is the best place to start. And so I think for that reason, commodities get screened out when people are doing portfolio optimization. But the second reason is I think there's this legacy belief that the only reason it makes sense to hold commodities in your portfolio is an inflation hedge. And really, there's a lot of heterogeneity within commodity markets, meaning like the way that cattle performs relative to oil is very different. The fact that they're under one roof or one umbrella from an asset class perspective, when they have such different properties and drivers of their risk and return, is kind of crazy. And so, if you think about the fact that commodities broadly are just labeled as this inflation hedge, it's because they're a real asset. But at the end of the day, because we had that small pocket of inflation and then it quickly started to trickle down, people are like, yeah, I missed the inflation wave. No reason to add commodities now. But hopefully, we've been able to articulate why, beyond a potential inflation hedge, commodities can offer so much more to a portfolio.
Yeah. Wow, Paisley, fantastic conversation. I love it. I learned a lot. I knew coming into this conversation, I would learn a lot. You brought a ton of great insight. I love it. And maybe most importantly, we're able to get through this conversation without having a Wisconsin Minnesota argument. So
I
kudos
do
to us.
love cheese curds, so I'll give
There
you
you
guys
go.
that. You did one thing right.
Yeah. That and New Glarus beer.
Yes, we tried
Spotted
spotted
cow.
cow.
Yes. At least there's two things we contributed
Yeah,
to the world. So thank you so much, Paisley, for coming on. It was a lot of fun. Where can our
appreciate it,
audience get
Ryan.
more information about Simplify Asset Management?
We would love to chat with anyone. You guys can reach out to me directly, of course, on LinkedIn or any socials. You can go to our website, simplify.us. There's a contact button. You can info or email us at info@simplify.us. We pride ourselves on leading with education. So if you go to our website, simplify.us, you'll find every single one of our strategies has research underpinning why we've developed this strategy, how we've developed it. And we have videos that help explain, for all the reasons we've already discussed, why some of these areas of the market are, uncomfortable for advisors. It's usually an education gap. So we are focused on educating advisors so that they understand the risk and return potential. They understand when and how these strategies are expected to work, and that they feel comfortable holding them and explaining them to their end clients. So please check out our website, and we're happy to engage. But thanks for having me, Ryan. I really appreciate it.
Yeah, yeah, it's been fun, and I know some may not believe this, but I actually do a little research before recording, and I went to the website just to see what you all are talking about. And the education is fantastic. I'm big on education. The content you guys produce, the videos, your podcast, you guys do great work. It
Happy to hear
was a
that.
great resource to me leading up to this. So good job.
Thank you. Appreciate it.
And thank you everyone for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to subscribe to those channels and give us a follow on LinkedIn. Thank you and have a great rest of your week.